Good morning, good afternoon, and good evening, wherever you are in this wonderful world of ours. Welcome to my podcast at North Star Charts. And today is the 9th of February 2021, coming to you from a still cold and quite snowy northeast England. I've got my web camera on for you today so you can actually see me. Whether that's a good thing or a bad thing, I'll let you decide. Um, just to remind you that you can find a link on my YouTube page to our free and absolutely brilliant newsletter, of course. It's the Silver Chartist newsletter, I would say that, wouldn't I? I'm biased. The Silver Chartist newsletter, put together by Steve Penny, with contributions from myself, Patrick Karim, and Jeff Clark, with lots of fundamental analysis on the miners to go with our technical analysis as well. You can find me on Twitter at North Star Charts, capital N, capital C, and again, there's the link there to our free newsletter. It comes out once a week, crammed full of charts and discussion, and a lot of actionable information in there as well. Should you wish to access it. So, the reason and the purpose for today's little podcast, is to talk about what I'm doing now in terms of, or what I'm thinking in terms of exit strategies. Now, you may, if you follow me on Twitter, know that I'm invested in cryptocurrencies and also gold and silver miners and the uranium miners, and one or two other things as well, platinum, copper. But those are the three main markets. So we'll take a look at the cryptocurrencies, and we'll use Bitcoin as a proxy for all of them, really, because they're all going to sort of move in the same general direction, with some surging at different times to others. But when well, at least I believe, when the market peaks later on this year, that will affect all of the cryptocurrencies. So you can use this advice, I suppose, for all of them. So here we have my analysis of the Bitcoin chart, and we've got two arcs which are formed, one down off the bottom left-hand side of the picture here, and the main one that's in the middle of the picture, which we've recently broken out of. And you can see this dotted line here, which was a resistance line, and I posted very strongly about it when we broke above around about $9,000, and particularly when we got to sort of the psychological $10,000 mark. I'd made some sort of purchases back down here when we broke out of this bullish pennant at around about $4,000 or $5,000, but I think most of my current purchases were in the $9,000 to $10,000 area. Of course, now we find ourselves up at what's reading over 46,000 today, so sort of quadrupled my sort of investment, more or less, with the cryptocurrencies. And it's a question of what to do now. And I'm confident that the market is going to trend higher for several weeks or even months to come yet. And with my initial crude cycle analysis, which I'll look at more closely nearer the time, but in very general terms, I'm pretty confident we're going to go beyond $100,000, and quite possibly well beyond $100,000, before peaking later on this year, and then declining very, very substantially, and probably losing well over 50%, and quite possibly 60% or more from wherever we get to, over a period of probably a couple of years, I suppose, before the next sort of major cycle begins. That might sound very dramatic, but it's very much in line with what's happened with the last 2 4-year cycles. So what to do? What to do, really? So you can either, I mean, in my case, because I got in quite a long while back, I'm going to play it safe, and I'm going to take out my initial stake in Bitcoin and the other cryptocurrencies, and probably a little bit more as well. Take some profit as well, and leave substantial sum to run through the remainder of the bull market as I see it, at zero risk. So I've got my own personal reasons for doing that. I've made a very good profit so far. I'd like to realise some of that. And everyone's got their own different risk tolerances. It depends as well on when you got into the market. If you didn't get in till 20,000 or higher, you may be more inclined to sort of leave your stake in there to multiply or gain get maximum gain from the coming upside. But I'm going to be a little bit risk averse and just take some of my profits now. and reinvest them. I'm not going to just leave them sitting around. They'll be reinvested. But don't get me wrong, I'm going to leave a reasonable amount of money in the cryptocurrencies and carry on following them. Okay, so that's cryptocurrencies. The same sort of thing applies across the other markets as well. This is some of the uranium miners, Energy Fuels. Now, I was fortunate enough to spot this descending bullish wedge, and the arc which I began drawing after this sort of touch down here, back at around about $1.50 near enough. And that's I kind of got into the uranium miners at around about that time. It was first half of last year, and of course we've seen gains of, again, probably 300 or 400% in these. So the uranium miners are very volatile, and because the underlying driver of the uranium market is obviously uranium itself, spot uranium, which has been very reluctant to increase above $30. Again, I'm going to play it safe and take out my initial stake and some profits and leave the remainder to run through what I see as being a very long and strong uranium bull market for all sorts of fundamental reasons. But if you get in early in these bull markets, then you're in a position where you can completely reduce your risk to zero by taking out your initial stake. And it wouldn't be impossible, of course, looking at this chart, for price to come all the way back down to test the arc somewhere down near to $2.20, $2.30, something like that. And that would be more than a sort of 50% drop in price. So by taking profits and your initial stake out, it enables you to take advantage of any kind of move like that that does develop. So it puts you in a pretty strong position having that cash on the side. So I'll be doing the same. I'll be taking out my initial stake and probably half the profits, and leaving a good sum to continue to play in the uranium bull market. So that's Energy Fuels. Fission Uranium, if you've been following my posts, it's up about 12% today, I noticed. And Fission Uranium, I was posting some very bullish looking charts quite some time ago. Computer's been very slow to load the chart. Here we go. So I've been spotting these bullish wedge formations one after another. And of course, the last one broke out somewhere down near, it was probably about 25 cents, something like that. Then price declined down on top of that wedge, as sometimes happened, and then accelerated to the upside, formed another bullish, well, bullish pennant or bullish wedge, and now it's accelerated up to my target, and it's reached my target up around 54 cents. It's just pulled back a little bit. In fact, I cashed in my profits and my initial stake at 54 cents just a short while ago today, and I'm expecting a strong likelihood of a sizable pullback here, and it could come all the way back down to, well, who knows where. As I say, uranium itself, spot uranium, hasn't really budged much in price for some time now. So we may see a sizable pullback, and by taking profits, you can take advantage of that. But again, in the longer term, I'd expect price to push through my initial target zone towards the top end, which is up above 85 cents, and then for an eventual breakout. So I'm not turning bearish on uranium. I'm just maximizing my chances of being able to take advantage of any sort of pullbacks. Just sit back with some sort of weight off my shoulders, being able to assess the situation. The silver miners, many of these, I've been posting about these, of course, for years, and have been gradually accumulating positions down at the down near these sort of low price levels. With silver one, it would have been somewhere around or below 20 cents where I started buying some shares, and particularly when we saw the breakout at around about 37 or 38 cents. Of course, we've gone up now to 79, it is today, and we're just pushing on the upper resistance line. Now, it could come all the way back down to support at 59, but at the moment I'm not really tempted to cash in any profits here, because we're in a bullish pennant that's still building out and it's yet to break to the upside. But having said that, looking at the gold and silver charts, it's quite important to be aware of where we are. And the gold chart is in a bullish or a bull flag, which has not yet broken out You can see the stochastic indicator hasn't turned up yet. And we've got some support here just below us at somewhere around $1,800, and then further support down near $1,700. Silver, a little bit different. Silver has broken to the upside, and we've seen the well, actually various upper resistance lines which have been broken to the upside one after another. And now the only one that really remains is the all-time high, which is a horizontal resistance line drawn from the previous, well, sorry, not all-time high, but the previous high from this bull run, which is around about $30, give or take. So it's that sort of psychological $30 level that we need to see the silver price pushing beyond to set the silver market on fire, really. And you can see the stochastic indicator is turned up and is moving bullishly in an upwards direction, but we need to see further follow through on this. So there, we've got to keep a close eye on what's happening with gold and silver, because of course the miners will react and react in in a larger way. So any up moves will be multiplied, and any downward moves will be multiplied as well. A big driving factor behind all of this, of course, is the dollar index, and the dollar index is key at the moment. And there's been some discussion on my Twitter page around what my thoughts are on the US dollar, and why I'm particularly bothered about the dollar falling, because just because the dollar's falling doesn't mean gold has to fall. Sorry, I get that the other way. I got that the wrong way around. So just because the dollar isn't falling doesn't mean that it will necessarily impact negatively on gold. So I'm not really explaining this very well, but what I'm trying to say is that a falling dollar index is often good for gold, and a rising dollar index is often bearish for gold, but that's not always the case, and I'm well aware of that. So I've been asked why I particularly feel that it's important at the moment to have the dollar index dropping, because it's not always necessary for gold to do well. And that's quite right, it's not. But the reason is because of the 3-year cycle in the dollar index, and we're nearing the end of a 3-year cycle at the moment. 2018 to 2021, and the 2018 low on the dollar index was 88.25, and we need to break that to the downside on this 3-year cycle to continue with a bearish outlook for the dollar index. If the low for this 3-year cycle is above 88.25, then that's bullish for the dollar index. It's putting a higher 3-year cycle low, and would change the outlook for the dollar cycle, for the 15-year dollar cycle, and the implications for those longer term 3-year cycles and the 15-year cycle would be bad for gold and silver. If you want to learn a little bit more about the significance of that, then go to Norvast on Twitter. Just type Norvast into the search tool, and you'll come up with Malcolm's page. He's actually very bearish on precious metals at the moment, and bullish on the dollar index, with a caveat that if 88.25 is broken to the downside, then obviously he'll be acknowledging the significance of that, and the what that means for gold, silver, and the dollar index going forward. So 88.25 is down below, obviously, where we are at the moment. You could view this current setup as a bearish sort of rising wedge, and there's a triangle in here. You can see the apex just here, so you could view that as a breakout above the triangle with an around the apex move down, which is pretty bearish. It tends to accelerate quite quickly away to the downside, which of course I'd quite like to see, because I'm holding gold and silver miners, and that would be good for the miners. But if we see this current move in the dollar index being terminated sometime in the next few days with the uptrend continuing, then that's going to give me some cause for concern. So, bearing all that in mind, and what I said about exit strategies and all the rest of it, if you have been in the miners for some time now and have been doing pretty well, then you might want to think about protecting some of those gains. You may be more bullish and less open to the prospects of a downside move, and wish to keep all of your investments right where they are in the miners. Um, but I'm just urging some caution and explaining that, you know, if you are fortunate enough to be sitting on some decent profits, then think about some downside support levels. Think about at what point you might want to consider um, um, taking those profits and basically sitting back and waiting to see what happens, because there's plenty of upside when gold breaks out to the upside. That really will be the sign when gold breaks this upside resistance line in tandem with the dollar index breaking 88.25 to the downside. That will be really the signal to go all out bullish on the precious metals, particularly with a weekly or a monthly close above those lines. You can have spikes, as you can see here above the line, but what you really need is a weekly close above that line, and then for that to be followed by a monthly close above the resistance line, and then you can be turning much more bullish. So just a thought, just something for you to think about and bear in mind. I hope you enjoyed all of that. Please post any questions and I'll do my best to answer them. But that's all from me for now. Thanks for watching and listening.